$129 in one trading session. Gold was at $5,000 this morning. By midday, it was at $4,879. If you are holding gold right now, you felt every dollar of that move. And the question every person watching this video is asking is the same question. Is this the start of something worse, or is this the setup I have been waiting for? That is exactly what this video is going to answer, not with a price prediction, with the data that is actually driving this move and the framework for reading what comes next. Last week, I told you to watch one specific thing, the COMEX registered silver inventory figure, and specifically whether it would break below 25 million ounces while the SGE premium stayed above $5. Here is what happened. The inventory picture did not dramatically resolve in either direction before today's session. But today changed the entire short-term context around that setup, because a single inflation print just repriced the entire precious metals complex in a matter of hours. So before I come back to the physical silver story we have been building, I need to walk you through exactly what happened today and why, because if you do not understand the mechanism behind this drop, you cannot read what comes next. My name is John, 15 years in currency and commodity markets before I ever picked up a camera. I have watched inflation data move markets more violently than almost any other single variable. I know what a genuine inflation shock looks like, and I know what a one-day overreaction looks like. Today, I want to help you tell the difference. This is Currency Insider. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. And if you are not subscribed, now is the time. Because what happened today is connected to everything we have been covering on this channel for the past 3 weeks. 3 things today. What the PPI number actually says and why it hit markets this hard, what it means specifically for the Fed decision happening right now as you watch this, and what the technical structure of gold and silver tells you about where support actually sits. Everything I show you comes from named, publicly available sources. Let us get into it. So here is the market picture as of midday today. April gold futures are down $129, trading at $4,879.20. That is a 6-week low. May silver futures are down $2.78, trading at $77.08, a 4-week low. The US dollar index is up on the session. Crude oil is trading around $99 a barrel. Still elevated, still adding to the inflation picture. The 10-year Treasury yield is sitting around 4.2%. And the Federal Reserve is meeting right now, with Powell's press conference due this afternoon. That is a lot happening simultaneously. And it all connects back to one number released this morning. So let me take you through that number carefully, because the headline grabbed the attention, but the detail inside the report is where the real signal lives. The U.S. Bureau of Labor Statistics released the Producer Price Index for February 2026 this morning. Producer prices, PPI, measure what businesses pay for goods and services before those costs reach the consumer. It is an upstream inflation indicator. What the market got this morning was not what it was expecting. Producer prices rose 0.7% month over month in February. The forecast was 0.3%. January came in at 0.5%. So February was not just higher than expected, it was higher than the already elevated January number, and more than double what economists had projected. That is the biggest monthly increase in producer prices in 7 months. Let me give you the detail inside that number because the composition matters. Goods prices soared 1.1%. The biggest monthly goods price increase since August 2023. That is not a rounding error. That is a genuine acceleration in the prices of physical things. Core PPI, which strips out food and energy, came in at 0.5%, above the forecast of 0.3%. On an annual basis, headline producer inflation jumped to 3.4%. That is the highest annual PPI reading in a year. 1 month ago, it was 2.9%. The market had expected it to stay at 2.9%. It did not. It jumped by 0.5 percentage point in a single month. Now here is why this matters for gold and silver specifically. And I want to be precise here because this is where the analysis gets counterintuitive. Gold is traditionally described as an inflation hedge, so a hot inflation print should be good for gold, right? Not necessarily. And understanding why requires understanding the difference between 2 types of inflation fear. The first type is slow-burn structural inflation, the kind where the purchasing power of currency erodes gradually over years, and hard assets preserve value. That is the environment where gold performs as a store of value and investors accumulate steadily. The second type is acute inflation shock, the kind where a single data print comes in significantly above forecast, and forces an immediate reassessment of how aggressive the Federal Reserve needs to be in response. Today is the second type, and in that environment, the immediate market reaction is almost always the same. Hot inflation data means the Fed might stay tighter for longer. Tighter for longer means higher interest rates for longer. Higher interest rates for longer means the US dollar strengthens. A stronger dollar means dollar-denominated commodities, including gold and silver, get repriced lower in the immediate term because they become more expensive for international buyers. Think of it like a seesaw. On one side, you have real interest rates, the return you get on safe assets like treasury bonds after accounting for inflation. On the other side, you have gold, a non-yielding asset. When real rates rise, the seesaw tips toward bonds, capital flows toward yield. Gold gets sold. What happened today is that the PPI print spooked markets into pricing a scenario where the Fed has less room to cut rates, real rates stay elevated for longer, and the opportunity cost of holding gold, a metal that pays no interest, goes up. That is the mechanism. That is why gold dropped $129 on an inflation report that, by any casual read, should be bullish for gold. Now here is the part that matters for how you interpret this, because this is where I want to give you the institutional context rather than the retail narrative. When I have watched these inflation shock sessions over 15 years, the question that matters most is not what the market is doing today. It is what the data is actually saying about the structural trend. And the structural question here is whether today's PPI print represents a genuine reacceleration of inflation, a new upward trend, or whether it represents the oil price impact from the Iran war feeding through into goods prices as a one-time supply shock. Those are two very different scenarios with very different implications for where gold goes over the next 3 to 6 months. If this is genuine reacceleration, inflation is broadening and building momentum. The Fed cannot cut. Real rates stay high. Gold faces a sustained headwind, even as it holds structural support from physical demand and central bank buying. If this is an oil-driven supply shock, one-time pass-through from crude above $99 into goods prices, then once the oil price stabilizes or the war premium fades, this inflationary impulse could fade with it. In that case, today's drop is a temporary repricing, not a trend change. The goods price component at 1.1%, the biggest since August 2023, that is consistent with an oil-driven goods shock rather than broad demand-driven inflation. Services inflation, which tends to be stickier and more indicative of underlying demand pressure, is the number to watch in next month's data. If you know someone who is watching their gold position today and trying to make sense of whether to hold, add, or reduce, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not finding it through a search on a day like today. Now let me bring in the Federal Reserve layer, because Powell is speaking this afternoon, and his press conference is the second binary event of today after this morning's PPI print. The consensus is a rate hold at 3.5 to 3.75%. That has not changed. What has changed is the context Powell is walking into. 3 weeks ago, he was navigating a Fed meeting with gold at 5,000 and the market expecting gradual easing. Today, he walks in with gold at 4,879, a PPI print that is double the forecast, crude oil at $99, and every journalist in that room ready to ask him whether the Iran war has permanently changed the inflation trajectory. What the market needs from Powell today is not a rate change. It is clarity on how the Fed is weighting two simultaneously bad scenarios, a potential growth slowdown from the Iran war on one side, and a genuine inflation reacceleration on the other. That is the definition of a stagflation setup. And the honest answer to how the Fed navigates a genuine stagflation setup is, with difficulty. There is no clean policy response. Raise rates to fight inflation, and you risk choking growth. Cut rates to support growth, and you risk embedding inflation. Powell will almost certainly acknowledge both risks and commit to neither path explicitly. That kind of ambiguity, deliberate, justified, but real, tends to create continued volatility rather than resolution. And continued volatility in the macro environment is not structurally bad for gold. It is disruptive in the short term. But it does not change the medium-term case that we have been building on this channel. Now let me talk about the technical picture, because this is where I want to give you the specific levels that actually matter today, rather than the levels that sound impressive on a chart. Gold. April futures are at 4,879.20 as of midday. The first support level that the technical picture shows is today's intraday low at 4,837.10. Below that, the next support sits at 4,800. Below that, and this is the level the bears need to push through to change the medium-term structure, solid technical support sits at 4,670. As long as gold holds above 4,800, this is a sharp correction inside a broader uptrend. If it breaks 4,670, the technical picture changes and a more significant retracement becomes the primary scenario. On the upside, first resistance is now back at 5,000. The level that was floor this morning is now ceiling. Then the week's high at 5,049. And the bull's real objective, the number that would confirm the uptrend is resuming, is a close above last week's high of 5,248. Those are the Wyckoff technical levels from this morning's market analysis. Now silver. May futures at $77.08. First support sits at today's intraday low of 75.63. Below that, 72.50 is the next support. The bear's objective is a close below 72.40. On the upside, first resistance is $80, a level silver was holding just days ago. Then this week's high at 82.76, and the bull's real target, the level that would signal silver's next major leg, is a close above $90. Both gold and silver are carrying a Wyckoff market rating of 5.0 today, exactly neutral. That means the technical picture is neither confirming a bear trend nor signaling a resumption of the bull trend. It is saying, wait and see what the next data gives you, and that neutral reading on a day with this much volatility is actually useful information. The market is shaken but not broken structurally. All right, let me show you how I am reading this week using the 3 lanes framework, because today changes some of what we were watching, and I want to be precise about what has shifted and what has not. Lane 1, the paper market, blue. Today is a paper market event. Managed money traders are selling gold and silver futures in response to an inflation print that changes their rate cut expectations. This is not physical sellers. This is not central banks liquidating. This is leveraged paper positions repricing to a new macro scenario in real time. The CFTC commitment of traders data will be worth watching after today's session to see the scale of positioning change. Key question: did the drop trigger forced liquidation of overleveraged longs, or was it an orderly reprice? Forced liquidation would mean the selling is mostly done. Orderly reprice means more may follow if the macro data continues to come in hot. Lane 2, the physical market, silver. Here is the critical point. Nothing about today's PPI print changes the SGE premium story. Nothing about it changes COMEX registered inventory. Nothing about it changes the structural demand from solar manufacturing or central bank buying. The paper price dropped $129 on gold. The physical market did not change its behavior in Shanghai. The divergence we have been tracking, the gap between what the paper market says and what the physical market is doing, just got wider in a different direction today. Physical buyers in Shanghai are not selling their silver because the US PPI came in hot. They are still paying a premium for physical delivery because their demand for real metal has not changed. Lane 3, macro, gold. This is the lane where today genuinely shifted something. The PPI print at 3.4% annually, highest in a year, changes the Fed's navigation challenge. DXY strengthened today. That is a genuine macro headwind for metals in the near term. The 10-year yield at 4.2%. The direction of that yield in the next 2 weeks will tell you more about where gold is heading than almost any other single variable. In 15 years in these markets, I have watched these inflation shock sessions more times than I can count. The ones that mark genuine trend changes are the ones where the hot data is confirmed by the following month's print and the month after. The ones that mark the best buying opportunities in retrospect are the ones where a single hot print caused a sharp overreaction that the underlying physical and structural demand eventually reversed. I do not know yet which one this is, but I know which variables will tell me, and I have just told you what they are. Here's the one thing I am personally watching this week, one specific thing, Powell's press conference this afternoon, and specifically the language he uses around the phrase stagflation risk. If Powell explicitly acknowledges stagflation risk as the primary framework the Fed is navigating, that is a signal that the Fed understands it cannot simply raise rates to fight this inflation without causing real economic damage. In a genuine stagflation acknowledgement scenario, the long-term case for gold strengthens even as the short-term price falls. If Powell dismisses stagflation risk and frames today's PPI as transitory, oil-driven, temporary, not embedding, the dollar strengthens further, real rates rise, and gold faces additional near-term pressure. The word to listen for is transitory. If Powell uses it, watch gold sell off further. If he avoids it and frames this as a genuine dual mandate tension, the selling pressure today may be closer to its end than its beginning. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what Powell said and exactly what the market did in the 24 hours after. No edits, no excuses. That is the only way this works. Now here is where I want to give you the full picture, both sides genuinely equal, because this is exactly the kind of session where it is tempting to pick a narrative and run with it. I am not doing that. Here is what needs to happen for the optimistic picture to develop from here. Powell this afternoon avoids the word transitory but frames the PPI as primarily oil-driven, a supply shock rather than demand-driven inflation. DXY stabilizes and stops strengthening. The 10-year yield does not push above 4.3%. Gold finds support at 4,800 and buyers step in. Physical buyers, central bank adjacent buyers, long-term holders who have been waiting for a pullback. Silver holds above 75.63, today's intraday low, and the SGE premium remains above $5, confirming that today's paper price drop has not been followed by a collapse in physical demand. In that scenario, today marks a sharp but temporary correction, and the medium-term structural case is intact. Here is what needs to happen for the cautious picture instead. Powell signals the Fed is genuinely concerned about inflation reacceleration and will not cut rates in 2026. DXY pushes back above 100. 10-year yields move toward 4.3 or higher. Gold breaks below 4,800 on a closing basis and tests 4,670 support. Next month's CPI and PPI data come in equally hot, confirming today was not a one-time oil shock but the beginning of a new inflation trend. In that scenario, the medium-term gold story faces a genuine structural headwind, and the correction has more to run. For UK investors holding gold in a SIPP, the LBMA benchmark price is your reference, and the Bank of England's response to US inflation data, which feeds into UK imported inflation via sterling and oil, is worth watching alongside the Fed. Both scenarios are live right now. Both are supported by evidence. The data over the next 30 days, the next CPI, the next PPI, the next Fed communication, will tell you which one is developing. Your job today is not to panic sell and not to blindly add. Your job is to know which numbers to watch and to watch them. Before we close, the disclaimer you need to hear. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if this kind of calm breakdown on a volatile day is what you have been looking for, the like button takes 1 second, and it genuinely helps this channel reach the people trying to navigate these markets without the noise. Hit it now. I want to ask you two things. First, how are you personally responding to today's drop? Are you holding, adding, or reducing your gold and silver position? And what data point would change your decision? Second, do you think today's PPI print is a genuine inflation reacceleration or an oil-driven supply shock that will fade? Drop both answers below. The comment section on a day like today becomes one of the most valuable real-time sentiment trackers in this space, and I read every single one. Subscribe because next week the first thing we do is come back to Powell's exact words this afternoon. I will pull the specific language, show you what the market did in the 24 hours after, and we will know together whether today's drop was the correction that sets up the next leg or the beginning of something more sustained. That is the most important follow-up in precious metals right now, and it is exactly what next week's video is going to deliver. And if someone in your life is watching their gold position today and feeling confused or anxious about what is happening, share this video with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.